Hi everyone and welcome to a new video. Today we see how to use the Geometric Brownian Motion to, in a way, forecast a stock price. The main use in general of this very powerful mathematical and stochastic tools such as the Geometric Brownian Motion is to price financial derivatives, also for instance Bermudan and American options. But we'll see this in one of the next videos, and today we'll just see how to simulate these future scenarios for the stock market. And okay, here I already downloaded the stock data with the Yahoo Finance library, and in particular I picked the SPY stock, so the Standard & Poor's 500. And okay, now we can start with our new part of the code, which is indeed the stock price forecast. First, we compute the return and the volatility of our stock. Okay, we usually, as usual, we compute the log returns. So we have the logarithm. So for NumPy, the log function of the stock prices over the stock prices shifted of 1 day. So shift 1. So the previous value, and we drop the not number values. Okay, we compute this, and we can, for instance, plot to better visualize them. So plot, and then the fixed size, the figure size is 10.5 to cover the whole page. If this is an equal, of course. And I forgot the show. Okay, so here these are the log returns in a time window of 5 years. I choose here. I'm not writing the title, the Y label for this plot because this is not the goal of the video. Okay, now we can compute the volatility. So first of all, we need to choose a rolling window in number of days. For instance, 1 month, which are in general 20 days or 21, as you prefer. And so volatility, we create this new variable volatility, which is the standard deviation of the log returns, considering a rolling window of 21 days. So dot rolling, and then we have window equal to our rolling window in days dot std. And since we want the year standard the year volatility, we just need to multiply by the square root of the trading days in a year, which are 252. We computed the volatility in this way, and we can plot also so plot, and then again we have the figure size, and then show. And here you can see the year volatility over the last 5 years. Okay, now we are in the main part of the video, which is the stock price forecast using the Geometric Brownian Motion. Okay. First, we consider some parameters, which are, we save the S0, so the stock price as of today, and I just need to write stock prices of -1 since the last value we downloaded from the market data. Then I have the risk-free rate, which I can consider, for instance, 5%, which is a reasonable value these days. Then I have the volatility of today, which as per the stock price, it's volatility of -1. And finally, the maturity. So in this case, this is not the maturity because we're not actually pricing a derivative or an option, but it's just the future time in which we want to simulate the values of the stock price. So for instance, t equal 1 means we want to simulate the values up to 1 year. And then we see, actually right now we see that we can specify how many values, how many intervals in this time window, 1 year. So how much we want to discretize this interval, and for instance we can choose 100 values, and then we have a number of simulations, so how many scenarios we want to simulate, which 10,000 can be good just to start, because we're not actually pricing a derivative. Then we, of course, the delta t is just the maturity over the time intervals, so t over n time intervals. Okay, the S forward here is just the initialization of our matrix, so mp dot 0, and then we have the dimension of the matrix, so n time intervals plus 1, because we're considering today and then all the values, and then the number of simulations. So nsim, and we fulfill the first column of the matrix, or actually the first row of the matrix as all today values, so as 0. That's the reason of this plus 1. So we initialize the first row at all as 0. And here we have a for loop. So for t in range of 1 up to n time intervals plus 1, so the dimension of we complete the dimension of the matrix column, and then we have s forwards of t is equal to, and here we have the geometric Brownian motion solution, so s forward of t minus 1, so the previous value, times the exponential of the risk-free rate minus a half times the volatility squared, this times the delta t, plus the volatility times the square root of the delta t, and of course times we need to generate, I have to close, we have to generate nsim values from the standard normal distribution, so mp from numpy random dot standard normal, and the number is exactly nsim. Okay, I think we're good, no mistakes, it seems. So before visualizing them, so before plotting them, we can, for instance, compute the delta stock price on average, of course. So we have delta stock price equal to the last value of S forward, so S forward of minus 1 minus S0, and we compute the mean. We can divide up with S0, so to have a percentage value. So we can create this new variable, delta stock price percentage, which is simply a string. So this seems difficult, but it's completely not, because I'm just writing to a string with, you consider the double, which then we'll see delta stock price with two values of 2 digits after the comma, so, and then in percentage format. So, and then we have format, and we just need to pass which value are considering, which is the delta stock price. So I'm doing this because now I can simply write stock price forecast, and then I have delta stock price in percentage, so it's already a string. And as you see, of course, in this case, the average of all our 10,000 simulation is 5.03%, but of course, since it's mathematics, the higher number you're considering for the simulation, the closer this result will be to the risk-free rate, of course. And but this, as I said before, this main tool is used for Monte Carlo simulations, and in particular for pricing derivatives. So you don't need to just focus on these values, because the higher you consider the number of simulation, the close will be to just 5% precise. And okay, having told this, we can plot the results, which is, I think, the best part of the video, because we can visualize everything we've done up to here. So I can write visual representation. And okay, first we create this figure with figure size of 10.5. It's not that easy to plot, because it's not the usual procedure, but it's not difficult at all. So dot plot, and here we have, for instance, we can plot the first I don't know, 50 values, 50 scenarios. So 0, 15, actually 51. Then I have the X label. I write in this case because it's good to have a very good plot, so this in the future. Then I have the Y label, which is the stock price. Then I have the title, which is stock price evolution. And finally, I just need to show it. And here you can see this is the canonical, I'd say, the classical representation of a Monte Carlo simulation over a discretized time window of 1 year. Here you see from 0 to 100, which is exactly the number of time interval we're considering, but you can see that as 1 year. And okay, this is the value of the Standard & Poor 500 stock as of today, and these are 51 scenarios that could happen in the future. For instance, and this is the main part of the video, if you want to price an American option, and for instance you have a barrier, a low barrier here in 350, or better, let's say down and out barrier option. So if you put a barrier, a down barrier here in 350, you can see that all the scenarios in which the stock price goes in some time goes below our 350 lower barrier, this scenario will die in that moment, and the price will be 0. And that's the reason we are considering also discretization, and not just considering the final values as of European options. Okay, we can last part, we can just see the stock price forecast distribution. So we again have our figure, and here we say the hist function, so the histogram, and I have again here we are considering just the final value, so we want to check where the final price is, how the final price is distributed in 1 year. And okay, the bins can be again 100, okay. And then I have to show, and as you can see, it's this is the distribution of the stock price, mostly of course 400 plus the 5%, and this is the main thing of the Geometric Brownian Motion. And that's it. I hope you enjoyed this video, and see you for the next one. Thank you for watching.